There is a quiet machine moving money through the market right now, and most people do not see it. That is what makes it powerful. It is not loud. It is not emotional. It does not announce itself on the evening news. It does not wait for retail investors to understand it. It simply moves. One sector at a time, from what is crowded into what is beginning to work, from what is obvious into what is still being ignored, from what everybody owns into what institutions are starting to accumulate. When you do not understand that machine, you can feel like the market is unfair. You can buy the index, watch the headlines, follow the biggest names, and still spend a year going almost nowhere. At the same time, a smaller group of stocks can move sharply higher because capital has quietly rotated into them before the crowd realized what was happening. That is not magic. It is how systems work. Money does not sit still. It moves according to incentives, pressure, liquidity, risk, policy, supply, demand, fear, and opportunity. If you learn to observe those flows, you do not need to guess perfectly. You simply need to understand where the probabilities are improving. Right now, as I look at the environment, I see money leaving some of the trades everyone talks about and moving into areas that many ordinary investors barely study. Two of those areas are especially important because they sit at the intersection of energy, infrastructure, inflation, geopolitics, and national security. That is where big moves often begin. Most people think investing is about finding a stock before it becomes popular. I think that is only partly right. A better way to think about it is this. First, understand the environment, then understand which sectors benefit from that environment, and only then look for the strongest companies inside those sectors. If you reverse that order, you usually end up chasing tips. If you follow that order, you begin to see the market as a system. The reason this matters now is that this is not the kind of market where everything goes up together. In 2021, a lot of people felt smart because almost anything they touched went higher. That kind of environment teaches the wrong lesson. It teaches people to believe that price increases are proof of skill. They are not. Sometimes price increases are just proof that liquidity is abundant and risk is being mispriced. Now the environment is different. Inflation is still a concern. Rates may not come down as quickly as many people hoped. Governments are still spending. Central banks are trying to manage conflicting pressures. Geopolitics is unstable. Energy is not simple. Supply chains are being reconsidered. Wars, oil, infrastructure, debt. Deficits and security are all connected. When the weather changes, the clothing has to change. That is one of the simplest principles I use. You do not have to predict every storm. You do not have to know the exact temperature next month, but you do have to dress for the weather you can see. Investors get into trouble when they wear yesterday's clothing and today's climate. The market is like the weather in that way. There are sunny periods, cloudy periods, and storms. You cannot control them, and you cannot predict them perfectly. But you can observe them. You can ask, what kind of environment are we actually in? What assets do well in that environment? What assets depend on assumptions that may no longer be true? That is where the real work begins. For many years, investors were rewarded for a very simple behavior: buy the index, buy the biggest companies, and let the passive money carry you. There is nothing wrong with understanding the benefits of low-cost index investing. It has been a powerful tool for many people. But every tool has a structure, and every structure has consequences. The S&P 500 is not an equal bet on 500 companies. It is weighted by market capitalization. That means the largest companies get the largest share of every dollar that flows into the index. When a company becomes bigger, more passive money automatically buys it. When more passive money buys it, it can become bigger. Still, this creates a flywheel. The flywheel can be very powerful. It can also become dangerous if people do not understand what they actually own. When investors buy the S&P 500, many of them believe they are buying broad diversification across the American economy. In one sense, they are. But in another sense, a large share of their money is concentrated in a small number of huge companies. The biggest names dominate the flow. The top companies become a much larger part of the index than most people realize. That is not a moral judgment. It is just how the machine is built. If Microsoft, Amazon, Nvidia, and the other largest companies become a large enough share of the index, then index investors are automatically reinforcing that concentration every time they buy. Pension money does it, retirement accounts do it, ETFs do it. Passive inflows do it. The larger companies absorb more of the automatic demand. That is why the biggest stocks can keep getting bigger long after they already look expensive. The structure itself helps them, but every structure also contains a risk. If the largest stocks are doing well, the index looks healthy. If those stocks stall, the index can look tired, even if money is moving somewhere else under the surface. A retail investor who only watches the index can miss the rotation completely. That is one of the biggest mistakes I see. People wake up, look at the S&P 500, check the same megacap stocks everyone else is checking, and ask what moved today. But the more important question is often different. Where is the money going before it becomes obvious? Institutional money is not always smarter in some mystical sense. It is usually more trained, more systematic, and more focused on flows. It rotates, it moves from crowded trades into uncrowded trades. It moves from expensive areas into cheaper areas when the probabilities change. It moves from sectors that already had their run into sectors where earnings policy and capital flows are starting to line up. That is the point. You do not need to predict which mega-cap stock will win the next headline battle. You need to learn how to follow money from one part of the system to another. The mainstream news usually explains these moves too late. It gives people a story after the price has already moved. That is why I do not start with the story. I start with the environment, then the sector, then the company. That framework matters more than any single ticker. The first part is the broad weather report. Where are we in the cycle? What is happening with inflation? What is happening with energy? What is happening with rates? What is happening with governments, deficits, supply chains, defense spending, infrastructure, and national security? You do not need to become a macroeconomist. In fact, too much complexity often makes people worse investors because they confuse more information with better judgment. You need a basic map. The second part is sector flow. Which areas are beginning to fill with money? Which sectors have tailwinds? Which ones are being accumulated while the headlines are still focused elsewhere? Which ones are benefiting from the weather we can already observe? This is where most investors skip the work. They go straight to the stock. They want the name, they want the ticker, they want the quick answer. But a stock without a sector tailwind is often just a hope. The third part is finding leaders inside the winning sectors, only after the broad environment and the sector flow makes sense. Do I want to look closely at individual companies at that point? The stock is not just a random idea, it is a vehicle inside a larger flow. That is the difference between a tip and a process. A tip makes you dependent on someone else, a process makes you independent. The process I am describing can work in bull markets, sideways markets, bear markets, and politically strange markets, because it is not built on predicting one perfect future. It is built on observing how money behaves as the environment changes. Right now, one area where I see that behavior clearly is energy infrastructure, especially the companies that provide the equipment, services, and machinery behind oil and gas. During a gold rush, the people who get rich are not always the miners. Sometimes they are the people selling the picks, shovels, tools, and infrastructure that make the mining possible. That principle applies to energy. There are companies that drill for oil and gas. Then there are companies that sell the drilling equipment, compressors, tools, services, maintenance, and infrastructure needed to get oil and gas out of the ground and move it where it needs to go. Those businesses can benefit when the world needs more energy development, more repair, more storage, more pipelines, more terminals, and more secure supply chains. This is important because the world still needs energy. That sounds obvious, but investors often forget obvious things when a popular narrative takes over. AI needs enormous amounts of energy. Data centers need power, industry needs power, countries need secure access to fuel. LNG infrastructure requires terminals, pipelines, export facilities, and specialized equipment. Geopolitical instability can make energy security more urgent. If a critical shipping route becomes unstable, governments and companies start thinking about storage, domestic capacity, backup routes, and infrastructure investment. That is not a stock story, that is a system story. If energy becomes more strategically important, the companies that enable energy production and transport can become more important too. If oil prices stay firm because supply is uncertain, producers may spend more. If LNG demand grows, infrastructure has to be built. If governments worry about energy security, capital can move toward the machinery and service providers that support that security. That is why I pay attention to this area. One of the names in this space is Baker Hughes, BKR. I am not saying that as a recommendation. I am describing how I would think through it. Baker Hughes is one of the major oilfield service companies in the world. It fits the picks and shovels idea because it provides equipment and services that help the energy system function. When energy infrastructure is being expanded, repaired, or made more secure, companies like this can become interesting. What I care about is not only the story. I care about whether the money is confirming the story. A good narrative without capital flow is just talk. A good narrative with capital flow becomes worth studying. When I look at a chart in this kind of situation, I am not trying to be clever. I am looking for behavior. Stocks often move in patterns of expansion and rest. They advance, pause, consolidate, and then either fail or break out. The pause matters because it tells you that buyers and sellers are reaching a temporary balance. The breakout matters because it can show that balance shifting. I do not want to buy a name simply because it sounds logical. I want to see whether the market is beginning to agree. With BKR, the important observation is that it has had periods where it moved sideways, built a base, and then pushed through prior highs. That kind of movement can indicate that institutions are accumulating shares and that the stock is trying to move into a new range. Volume matters in that process. If price pushes through resistance and volume expands, that tells me the move may have stronger backing. Again, none of this is certainty, it is probability. Investing is not about being certain. It is about understanding what can happen, what is likely to happen, what can go wrong, and how much you can lose if you are wrong. Another name in the energy infrastructure area is NPK, which is a smaller company connected to temporary worksite infrastructure for energy and construction projects. It is not the same kind of company as a giant oilfield service provider, but it also fits the idea that infrastructure spending and energy development can create demand for the businesses that support the work. Smaller companies can move more sharply, but they also carry more risk. That is why process matters even more. A smaller stock that has already risen a great deal is not automatically too late, but it is also not automatically safe. I want to understand ownership momentum, institutional interest, and where the stock has been pausing. I want to see whether it breaks out from a base, not just whether it has an exciting story. This is where many investors misunderstand buying strength. They think buying after a breakout means overpaying. Sometimes it does, sometimes it is reckless. But in many institutional playbooks, buying a little above a prior high can make sense because it confirms that demand has become strong enough to absorb supply. You are not buying because the price is higher. You are buying because the behavior of the stock may have changed. That distinction matters. Buying low sounds intelligent, but sometimes what looks low keeps getting lower because there is no demand. Buying strength sounds unintelligent, but sometimes it means you are aligning with a flow that is just beginning to reveal itself. The principle is not to chase anything. The principle is to require confirmation. If a stock has been moving sideways and then breaks above the range with strong demand, that can be evidence that the market is beginning to market differently. I still need risk control, I still need position sizing, I still need to know what would prove me wrong, but I am more interested after confirmation than before it. That is how I think about the first sector. Energy, equipment, and infrastructure are not glamorous. That is part of why they can become interesting. Everyone wants to talk about the obvious technology winners. Fewer people want to study the equipment, the pipelines, the compressors, the LNG terminals, and the less exciting parts of the system. But wealth is often created in places people do not want to look until after the price has moved. The second area is critical minerals. Mining, uranium, lithium, rare earths, and the materials required for an electrified, power-hungry, strategically divided world. On the surface, this can sound boring. Mining and quarrying of non-metallic minerals does not sound like a phrase that makes people excited. But markets often reward the things that are necessary, not the things that sound exciting. The world is becoming more electric. Electric vehicles require lithium and other materials. Batteries require minerals. Solar and wind require storage because the sun does not shine at night and the wind does not always blow when demand is highest. The grid needs modernization. AI data centers require power and cooling. Defense applications require secure access to materials. Countries do not want to depend on rivals for the minerals that power their industries, weapons systems, grids, and future technologies. This creates a different kind of demand, not just consumer demand, strategic demand. When governments begin to treat a supply chain as a national security issue, capital can move differently. Financing appears, policy support appears, domestic capacity becomes more valuable. Companies connected to that capacity can benefit if the market begins to recognize the importance of the problem. Again, this is not a prediction that every mining company will work. That would be lazy thinking. It means the sector deserves attention because the environment is creating pressure in its favor. One company in this space is SQM, Sociedad Q Fábrica y Minera de Chile, a major lithium producer. Lithium has gone through cycles, and these cycles can be brutal because commodity markets always involve supply, demand, price, capacity, and sentiment. But if the world continues to need batteries and electrification, lithium producers remain important. The key question is not simply whether the world needs lithium. The world can need something and still overpay for the wrong company at the wrong time. The key is whether the company, the sector, and the price behavior are beginning to align. With SQM, the kind of thing I would watch is whether the stock has moved sideways long enough to form a base and whether it can break above important prior highs. I do not want to buy simply because the story sounds logical. I want to see whether the market is beginning to change its mind. That is why I can sometimes prefer to buy at a higher price than today's price. Not because I like paying more, because I like paying after the probabilities improve. This is a very important distinction for people who have been taught only one simple idea: buy cheap. Cheap is good only when value is real and conditions improve. Cheap can also be a trap when capital is leaving, earnings are deteriorating, or the sector is still being abandoned in cyclical areas. Cheap can remain cheap for a long time. Confirmation is the bridge between an idea and an action. Another company that fits this world is Uranium Energy Corp, UEC. Uranium matters because nuclear power is becoming part of the energy security conversation. Again, data centers need enormous energy. Governments want reliable power. Countries want domestic supply. The United States does not want to be dependent on uncertain or hostile supply chains for uranium. That makes domestic uranium production strategically important. UEC has been connected to new U.S. uranium production, including operations in Texas and Wyoming. The point is not to fall in love with the company. The point is to understand why the market might begin paying attention to the category. If AI requires power, and if nuclear power becomes part of the answer, and if domestic uranium becomes a strategic priority, then uranium companies may be watched more closely. But the same rule applies. I do not want to buy a thesis alone. I want to see whether the stock's behavior shows that the thesis is attracting money. If a stock had a strong rally, then a sharp collapse, then begins forming higher lows. That can be an early sign that selling pressure is weakening. But early is not always actionable. Sometimes early means you should watch, not buy. There is a difference between a watch list and a position. That difference is how you protect yourself. A watch list says, this could matter. A position says, the evidence is good enough and the risk is defined. Many investors confuse the two and get into trouble. They hear a good story and immediately want to act. I think that is a human weakness. We want certainty, we want urgency, we want to believe we discovered something. But good investing requires separating interest from action. UEC may be interesting because of the uranium and nuclear energy theme, but I still need the price action to improve enough to justify risk. Another name in the mineral and rare earth area is CMP. With a company like that, the question is again whether it is close to breaking out of a range. If the prior high is around a certain level, I may be more interested only after the stock moves above it. That means I may intentionally wait until the stock is more expensive than it is today. Most people think that is strange because they have been trained to believe the only intelligent thing is to buy lower. But in markets, lower is not always better. Better is better. Better means the odds are improving, the money is flowing, the risk can be defined, and the stock is behaving in a way that confirms the thesis. That is why I focus on the process instead of the excitement. The deeper point is this: the market is not one single thing. News reports make it sound as if the stock market went up or down as though all stocks moved together. That is not how I think about it. I think of the market like a chessboard. Each sector is a square: technology, energy, uranium, oil services, mining, gold miners, insurance, healthcare, electronic components, construction, and many others all sit on the board. Money moves across the board. When money leaves one square, it may enter another. When one area becomes crowded, another may become neglected. When the weather changes, the sectors that benefit also change. If you only watch the index, you may think nothing is happening. Under the surface, everything may be happening. That is why people can be frustrated while other people are making money. One investor is staring at the S&P 500 and saying the market is going nowhere. Another investor is watching sector rotation and saying money is leaving one area and entering another. Both can be looking at the same market, only one is seeing the flows. This is especially important when the largest stocks dominate the index. If a handful of mega-cap companies stall, the index may look tired, but smaller or less popular sectors may be advancing. If you do not understand rotation, you may miss those advances because your attention is trapped by the headline index. That is why the structure of passive investing matters. When the biggest companies dominate index flows, they can hide what is happening elsewhere. People think they are diversified, but they may be highly exposed to the same set of giants that can work beautifully while the giants lead. It can become frustrating when leadership broadens or rotates. This does not mean index investing is bad. It means you should understand the machine you are inside. Every machine has benefits and vulnerabilities. Passive investing is cheap, simple, and powerful. It also creates concentration and automatic buying of the largest companies. If you know that, you can decide how much exposure you want. You can even choose concentrated exposure deliberately. But if you do not know it, you may believe you own something more balanced than you really do. Understanding is the first risk control. The next risk control is position sizing. I do not think any single idea should be allowed to damage you badly. If I am wrong, I want to know in advance how wrong I can afford to be. A position can be larger than 1% of a portfolio, but the risk on that position can still be controlled so that the maximum loss from that idea is limited. The exact number depends on the person, the portfolio, and the strategy. The principle is what matters. Risk what you can afford to lose from the risk bucket. Do not risk your ability to stay in the game. That is how you sleep well at night. It is also how you avoid emotional decisions. When a position is too large, your biology takes over. You stop thinking in probabilities and start thinking in fear. You refresh the screen. You look for opinions that comfort you. You turn a process into a stress machine that is not investing, that is emotional dependency. The better way is to decide in advance. What is the thesis? What is the entry? What would confirm it? What would invalidate it? How much am I willing to lose if I am wrong? Am I scaling in, or am I dumping money into something I do not yet understand? Scaling matters because the future is uncertain. If you are entering a new sector, you do not need to put a large amount of money into it immediately. You can build exposure over time. You can learn. You can watch how the sector behaves. You can increase only if the evidence improves. This is how professionals think. They do not need one dramatic decision. They build positions as evidence accumulates. Retail investors often do the opposite. They wait until they feel certain, then put too much money in at once. The problem is that certainty often arrives late, after the price has already moved and after the easy part of the trade is gone. That is why process beats emotion. The process I am describing does not require you to be glued to the screen all day. It may require an hour a week if you do it seriously. You review the macro weather, you rank the sectors, you update your watch list, you look for leadership, you study where money is entering and leaving. If someone works 40 or 50 or 60 hours a week to earn money and cannot spend 1 hour understanding how that money is managed, that is a problem. It does not mean they are unintelligent. It means the system trained them to earn money but not to manage it. That is a dangerous imbalance. The goal is not to become a professional trader overnight. The goal is to stop being blind to the way money moves. Once you understand rotation, the market becomes less mysterious. You begin to see that even when the index is flat, money is not frozen. It is moving through the system, searching for better conditions. Sometimes it moves into oil and gas services, sometimes it moves into construction, sometimes it moves into insurance or healthcare, sometimes it moves into electronic components, sometimes it moves into defense. Sometimes it moves into mining. The names change, but the principle stays the same: follow the money. That phrase sounds simple, but it contains a full way of thinking. It means do not get trapped by headlines. Do not assume the market is the index. Do not start with a stock tip. Do not buy a narrative without confirmation. Do not confuse a watch list with a position. Do not take a position without risk control. It also means respect cycles. Everything moves in cycles: economies, debt, liquidity, sectors, investor psychology, and price. When a trade becomes too crowded, future returns often get worse because too much optimism is already priced in. When a sector becomes neglected but conditions begin improving, future returns can improve because capital has not yet fully arrived. That is the opportunity in rotation. Not every rotation becomes a major trend. Not every breakout works. Not every sector thesis is correct. That is why risk management is not optional. It is the foundation. A system that wins sometimes but can destroy you once is not a good system. A system that lets you be wrong and survive is much better. I think this is one of the biggest differences between amateurs and professionals. Amateurs want to know what to buy. Professionals want to know what could go wrong, how much they can lose, and whether the probabilities justify the risk. That is the kind of thinking I would bring to the sectors we have been discussing. Energy equipment and infrastructure are interesting because energy demand, LNG build-out, AI power needs, geopolitical instability, and energy security all point toward the need for more infrastructure. Companies like Baker Hughes and NPK sit near the tools and services side of that system. Critical minerals are interesting because electrification, batteries, grid modernization, AI power demand, defense applications, and domestic supply chains all point toward materials becoming strategically important. Companies like SQM, UEC, and CMP sit near different parts of that system. But the tickers are not the lesson. The lesson is the flow. If you only hear the tickers, you have missed the most important part. A ticker is just the surface. The deeper structure is the movement of capital through the economy as conditions change. That is why I do not think of this as gambling on meme stocks or chasing excitement. I think of it as studying how money moves through a complex machine. In a complex machine, small changes in one area can create large consequences in another. Higher energy demand can affect oil services. Geopolitical risk can affect infrastructure spending. AI data centers can affect power, cooling, uranium, and minerals. Government financing can affect domestic supply chains. Index concentration can affect how investors experience the market. Passive flows can amplify the largest stocks until leadership changes. These are cause and effect chains. When you see the change, you see the market more clearly. When you do not see them, you react to noise. The average investor often reacts to noise because the financial media is built to reward noise. It wants a reason every day. The market rose because of one headline, the market fell because of another. A stock moved because someone said something that creates activity, but not necessarily understanding. Understanding comes from asking better questions. What is the environment? Where is capital flowing? Which sectors are gaining strength? Which companies are leading inside those sectors? Where is the price confirming the idea? Where is the risk defined? What would make the thesis wrong? Those questions are boring compared with a stock tip, but they are far more useful. They turn investing from a guessing game into a decision process. The most dangerous investor is not the one who knows too little. It is often the one who knows a little and thinks that is enough. A person hears that lithium matters, so they buy a lithium stock. They hear that uranium matters, so they buy uranium. They hear that AI needs power, so they buy anything connected to energy. That is not a process. That is association. A process requires sequence, broad environment first. Sector flow next, company leadership after that. Risk control always. That sequence keeps you from being seduced by a good story at the wrong time. The market will always offer good stories. Good stories are easy to find. The hard part is finding the moment when the story, the flow, and the price behavior align. That is what I am watching now. If the index moves sideways over the next year while money rotates into less obvious areas, many people will feel confused. They will say the market is not doing anything, but parts of the market may be doing a great deal. That is why I think this moment matters. It is not because anyone can know the future with certainty. Nobody can. It is because the environment has changed enough that old assumptions may not work as well as they did. The buy anything environment is not the same as an environment shaped by inflation pressure, higher for longer rates, energy demand, geopolitical risk, and strategic supply chains. In that world, what you own matters more than when you own it. The sector matters. The flow matters, the risk management matters, and the humility matters. Most of all, humility is not weakness. Humility is the recognition that the market is bigger than you, that the future is uncertain, and that your job is not to be right all the time. Your job is to make good decisions repeatedly under uncertainty. That means being willing to watch. It means being willing to wait for confirmation. It means being willing to pay a little more if the probability improves. It means being willing to leave if the money leaves. It means not marrying a stock, not worshiping a narrative, and not confusing confidence with truth. The best investors I know are not the ones who sound the most certain. They are the ones who adapt fastest when the evidence changes. That is why following the money is powerful. It keeps you connected to reality. If money is flowing into a sector, you study it. If leadership emerges, you study the leaders. If the breakout confirms, you consider action with defined risk. If the flow fades, you stop pretending. That is a healthier way to operate. It also prevents a very common mistake, staying trapped in yesterday's winners because they made you money before. Every cycle has leaders. Every cycle also changes. The companies that dominate one phase may continue to matter, but that does not mean they will always deliver the best opportunity from today. Price. The market does not owe loyalty to yesterday. Winners. It rewards the areas where future conditions and capital flows are improving. That is why I pay attention to sectors most people are not discussing. Not because being contrarian is automatically good. Being contrarian just to be different is foolish. I pay attention because uncrowded areas can offer better asymmetry when the underlying conditions begin to improve and capital begins moving in. Asymmetry is what matters. If the downside is defined and the upside can expand, because institutions are still early, the opportunity can be attractive. If the downside is undefined and everyone already believes the story, the opportunity may be much less attractive even if the company is excellent. Excellent companies can be poor investments at the wrong price. Unpopular sectors can become strong investments when conditions shift. That is one of the great lessons of markets. So when I look at energy equipment and critical minerals, I am not looking for excitement. I am looking for evidence of a larger transition in capital allocation. I am looking at the weather. I am looking at the chessboard. I am looking at where money is leaving and where it is entering. Then I am looking for the names that can express that flow. BKR is a large energy services name that sits close to the infrastructure and equipment side of oil and gas. NPK is a smaller infrastructure-related name connected to energy and construction work. SQM is a major lithium producer tied to battery and electrification demand. UEC is tied to uranium and the return of nuclear power as part of the energy security conversation. CMP is tied to minerals and rare earth exposure. Those names are not commands. They are examples of how the process moves from environment to sector to company. A person who simply buys them because they heard the names has not learned the lesson. A person who understands why they are on the watch list, what conditions support them, what price behavior matters, and how to manage risk has learned something far more valuable. That is the real opportunity. Not one stock, a better way to see. If you can see the rotation before it becomes obvious, you give yourself a chance to outperform without gambling recklessly. You may still be wrong on individual names, you may still have losing trades, that is part of the game, but you will no longer be sitting passively in confusion while the money moves somewhere else. You will know what to look for, and that changes everything. The market is not fair to people who do not understand its structure. It does not slow down to explain itself. It does not reward hope. It does not care that you bought something because it was popular. It does not care that an index feels safe if the concentration inside it is higher than you realized. The market rewards preparation, observation, adaptability, and risk control. That is why I keep coming back to principles. Dress for the weather you can see, understand the machine you are inside. Do not start with the ticker. Follow the money, require confirmation. Control the risk, scale carefully. Leave when the evidence changes. Those principles are simple, but simple does not mean easy. They require discipline because human nature pulls in the opposite direction. Human nature wants certainty, it wants shortcuts, it wants excitement. It wants to buy what everyone else is buying because crowds feel safe, but crowds often feel safest near the end of a move. And lonely sectors often feel most uncomfortable near the beginning of one. That is why the current rotation matters. If capital is moving into energy infrastructure and critical minerals, while the broader index struggles or crawls sideways, the people who only watch the obvious names may miss it. They may spend the next year waiting for yesterday's leadership to return while tomorrow's leadership is quietly being built. I am not saying I know exactly how it will play out. I am saying the evidence is worth watching. That is what responsible investing looks like. It does not require certainty. It requires a system for dealing with uncertainty. When you understand the system, you stop asking for predictions and start asking for probabilities. You stop asking what stock someone likes and start asking why money would move there, what would confirm it, and what would make it wrong. That is the shift. The investor who makes that shift is no longer dependent on noise. They are no longer trapped by headlines. They begin to see the market beneath the market. That is where the opportunity is. Because the headline is rarely the whole story, the index is rarely the whole market. The most obvious stocks are rarely the only place money is moving. And the biggest opportunity is often not where attention already is, but where capital is quietly accumulating before attention arrives. If you can learn to see that, you do not need to be early in a reckless way. You need to be prepared in a disciplined way. That means having your watch list ready before the breakout. It means knowing the sector thesis before the headline catches up. It means knowing the risk before you enter. It means being able to act calmly because you already did the thinking. That is the goal. Calm. Prepared action in a world that rewards people who understand flows and punishes people who chase noise. The quiet machine is moving. Most people will notice it only after the results show up in the price. Your job is to notice the structure before that. Follow the money responsibly and never forget that the first rule is not to get rich quickly. The first rule is to stay in the game long enough for good decisions to compound.